everyone, so in this lesson we're going to be covering structure and order flow. So the points we're going to cover in this lesson: market structure, identify strong and weak breaks of structure, and order flow. So market structure is the simplest form of price movement that is made up of swing highs and lows, support and resistance, and supply and demand zones. Market structure can also be referred to as price action, and when I say price action, it's not to be confused with the trading style. Price action, we're more referring to what's happening in the markets. Now in this example here, we've got a swing high or a higher high and a swing low or a higher low. Now what this is showing us is where price is pushing above the swing high or the higher high is that price is wanting to push higher. Now if we had a break down past the swing low or the higher low, we'd then be looking at a market that's trying to push downwards. Now in a very similar example here, we've got a supply and demand zones. Now the supply zone can also be seen as a swing high or a higher high, but looking a bit closer into what that higher high is, we can see that it is a supply zone, and the swing low, we can see it's actually a demand zone as well in this particular example. Now as price is pushed past the supply zone, this is showing us that demand is stronger than the supply. So when price comes back down to the demand zone, we would expect this to hold rather than the supply. And this is where we'd be potentially looking for a trade. In this example here, we've got support and resistance. Okay, you can see price has just gone sideways for a bit and then it's broken past the resistance zone. Okay, so this is a bit of structure that has been broken, and we can look for a potential long from there, but then if price pushes down past the support zone, we could then be looking for shorts from there as well. So moving on from our nice, tidy, clean drawings, we can see this is a bit of real price action from the markets. Okay, so we've developed lower highs, lower lows, lower highs, lower lows. So this is kind of what it would look like for real, and it's not obviously as clean and straightforward as it looks in the diagrams. So what we can see here, we formed a lower high towards the top, and as prices push down, we've then created this lower low. Okay, now this is caused by a wick. We've had a bit of an aggressive pull away from where it's our first lower low, and price has pulled up to then create this lower high, but it's then failed to push past the first lower high, and price has lost its momentum and has continued bearish. Okay, so we've pushed down, we've then had another wick, quite a strong rejection as you can see there, to form the third lower high. So we've had a rejection, it's pushed up, and then it's rejected quite aggressively again. Okay, and it's continued pushing down to form the last lower low, and it's lost its momentum there, and it's tried to push back up again. However, it hasn't had enough commitment to push past the previous lower high, and we've started to pull back again to the downside. So break of structure. A break of structure is when price goes beyond the structure points previously mentioned. However, how this happens can give us a better idea as to if price is committed to the move or not. So for example, if we're looking for a long trade, we want the candle to close above the structure break, as this shows commitment. If price only wicks above the structure, this could be a liquidity grab to trap traders, and this concept will be covered in a lot more detail in later on lessons. So here's some examples. So here we have a break of structure, commonly seen on my charts, and most people's charts as BOS. So if you ever see BOS, that's what it means. It means break of structure. So here you can see that this candle just here is the candle that is closed above the structure. Now this is showing us that there is commitment for price to stay above this area, and if it does come back down, it would usually just be to collect orders and continue bullish. So this is what we prefer to see for a break of structure rather than a wick past, which would look like this. So here we can see a break of structure, okay, but I've labelled this as wick because it's only the wick here that has broken past it. Now, this doesn't mean that if price only wicks above it, that it's not going to be a profitable long trade in this example. It's just less favourable. So when I'm trading, I prefer to see a full body candle close. I like to see the candle close above the structure for me to consider that as a true breaker structure. It won't be very often that I would ever mark out a weak breaker structure and use that as a confluence towards a trade. So looking at the first example, this would be a higher probability confluence rather than the example on the right, as this is showing that as price pushed above that structure, there was an aggressive pullback and sellers were in control of the market. So moving on to order flow. Order flow is when price moves up or down, mitigating multiple supply and demand zones. By following order flow, we can anticipate future price movements. So in this example, we can see we've had the first demand zone, price has pushed up, it's come back to mitigate that area, but as it's then broken the previous structure, it's created another demand zone, and it's come back to mitigate that, and as it's pushed up again to break previous structure, we've created a third demand zone, and as you can see, the red line is where we anticipate price to come back to this area to push past the previous structure again. So here we have an example of bearish order flow in the markets. Now, if you've seen the order block video, you'll see that the first supply zone doesn't fully meet our criteria. However, in this example, it would still be valid purely based off the formation of the second supply zone. Now, with the second supply zone, this was formed through the mitigation of the first supply zone. So now we've got two supply zones following bearish order flow. We could then start to anticipate that the third supply zone is going to be bearish as well, providing we still get the breaks of structure and price is still moving in the same direction. Now, where the third supply zone is formed, if that did not cause a break of structure, then we would not be looking for a short in this example. However, as it does break structure, we could then be looking for a short trade to follow the order flow of the market. Let's go into a little bit more detail of the previous screenshot. Now, that screenshot was taken from the US 30 or the Dow Jones, okay, and so I've just elaborated a little bit more detail just to give a better perspective of how this order flow was playing out. So here's the first supply zone that we had, and as you can see, it didn't really break structure, this supply zone. Okay, so we've got our structure point here. This was the swing low. Okay, so that area did not get broken. Now, where we became interested in this order flow was when this mitigation happened and then formed the second supply zone. Okay, because this one here is what broke this structure, and we also then broke this structure here, which I shall mark out as well. So we've had these two breaks of structure. So let's mark those two out. So we've had this bit of structure broken, and then we've had this swing low broken here. Now, when that's happened, we've then had a pullback. We've tapped into or mitigated this supply zone, and then we've had another impulsive movement. Okay, price has broken this bit of structure here, and then we've got these relatively equal lows here, which has then been broken. So we've kind of got a support and resistance area here, which has been broken past. We had a wick past it. However, after that wick, we've then had price close below there. So this is then giving us a bit of confirmation that there is a bit of commitment in the markets to continue pushing lower. Okay, as you can see, we then had a pullback again, and we've then created what looks like another sort of support area here. So we've got this bit of structure that potentially could be broken in the future. We've had a pullback. We've then mitigated this zone and to continue our bearish movement. Now, as you can see, if we push further, it's just continued pushing down. So if you were going to be looking for a trade, me personally, I'd be looking at this area, because after this mitigation has happened, confirming these two supply zones are creating bearish order flow, this is where I'll be looking to get into a trade. use an order flow as my confluence. If you were being a little bit more aggressive, and if this supply zone was cleaner and it had a better breaker structure, you could then start looking at this area for a entry as well, and then when you have another supply zone created, you could potentially have a scaling trade from there on. But for this example, because the first order supply zone didn't meet all our requirements for its formation, that's why I'll be looking at this one for the trade, saying that if this did meet all our requirements and this one caused a breaker structure, then we could look at the second supply zone at the earliest for a trade.